All right, real estate in focus today. A lot of things are, of course, with that Fed rate cut that we're expecting in just a few hours. The rate on a 30-year mortgage did hit a 3-year low, this ahead of the Fed meeting. Walker & Dunlop Chairman and CEO Willie Walker joins us now. We'll talk, let's start on rates. Good to see you, by the way.
Nice to see you, David. Nice to see you, Sarah.
What is it going to mean for this 25 basis point cut, particularly for the mortgage market, given the longer end may not be moving quite as much, although Sarah pointed out the 10-year has been coming down a bit.
You have conviction that's only be 25?
I'll turn to my expert.
You think it's going to be 50?
I don't think it's. David said it with such conviction that maybe you knew something that I didn't know.
Just 100% priced in the market.
I talked to the experts. And I don't know, so.
No, but David, to your point, if you look back.
I'm an expert. You're a titan, by the way.
His hair is titan-esque.
He's just jealous of your hair.
Wow.
I got it.
Wait a second. I can be jealous of a lot of things, but not hair.
So if you look at the 9 rate cuts since 1980 until now, those done during recessionary times tend to pull down the long end of the curve. Those done in non-recessionary times, which would be now, don't have a big impact on the long end of the curve. So who knows? The stupidest thing for me to do is try and predict where rates are going to go. But I would just say, as it relates to where mortgage rates have gone on both the single-family side as well as on the commercial side, we're in a much, much better landscape today than we have been for quite some time.
So do we think we're going to see a significant uptick overall in the housing economy?
You know, the Trump administration has been working very, very hard to get rates down, and they are going to come out with, I believe, an executive order in the next couple of weeks, really focusing on housing. Look, we have a housing crisis. We have an affordability crisis in the United States right now. And so unless we get rates coming down significantly or we get the cost of building down significantly, we're going to continue to have that imbalance as it relates to the number of people who want to live in a single-family home and the number of people who can afford a single-family home.
Okay, so you seem to be somewhat optimistic that we are going to get closer to that balance.
Look, I just saw Kramer as I was walking up here, and he said to me, you know, you're in the right space for the next couple of years as it relates to where housing is going to go and where rates are going to go. We've had, from a secular trend standpoint, basically 3 years of higher interest rates. Housing has had problems in getting both manufactured as well as absorbed. And I think that we would think that for the next several years, as rates are where they are or come down a little bit, that it will be very accommodative to the housing sector, both multifamily as well as
prices come down too, because that's what we've been waiting for.
You know, the big thing there, Sarah, is that our research company Zelman has been out to all the home builders. One of the big surprises in their most recent survey is that the cost of manufacturing single-family homes has not gone up due to tariffs. Many, many people in the single-family space thought that the cost of manufacturing was going to go up due to tariffs. That has not shown up yet. And basically, inflation has been removed from the single-family construction as well as multifamily construction industries right now. Those numbers are kind of flat. Doesn't mean everything didn't move up in 22, 23, 24. So it's not like it's cheap to build, but we're not seeing the inflationary pressures that are going to push those costs up from here. So it's pretty good for building new supply.
Fannie and Freddie, not unimportant when it comes to the mortgage market, the housing market overall. We've reported a lot on it. I have as well. There's an IPO coming at some point, probably soon. Lutnick's out where you are, talking about the timing being near term.
Yep.
I'm curious, you know, again, no specifics, no clue in terms of the senior preferred and whether they're going to try and convert it and what exactly the IPO is going to look like and whether it's a tiny little spec. Do you have any expectations, A, for what the structure may look like, and B, what it will mean once they are no longer, or if they're no longer under conservatorship?
So a couple things are important to keep in mind there, David. The first is that Director Pulte has done a great job of getting these companies ready to go public. Okay, so as the director of FHFA, he's really focused on growing the top line, growing the bottom line, and getting these companies ready to be able to go public. And that's been very, very positive. How they come out, there are two things that Director Pulte as well as the president have continued to talk about. The first is to maximize the returns to shareholders, us, taxpayers. So try and get a number that says to all of us, the federal government stepped in, bailed them out, and we're going to get back a lot for that. So that's number one. The second one is not changing the cost of borrowing to the U.S. consumer. And if you think about those two things, what it says is that there's going to have to be either the implicit guarantee that is in place today with a really strong scaffolding that tells investors the federal government would step in troubled times, or an explicit guarantee, which would mean they'd have to go to Congress, and I don't think they go that path.
Right.
So everything that I'm hearing would say that they will take them out in some type of structure that says to investors, the federal government is still in, and that there is going to be a guarantee that makes investors not only know that this federal government will step in, but that the cost of borrowing to us as consumers won't go up.
Yep.
And as long as that stays in place, whatever structure it takes as far as an IPO, I think will be net beneficial.
Real quick, 40 seconds, but the long conversation we've had about commercial real estate, what are you hearing, what are you seeing in terms of the willingness of capital to potentially flow into that sector again?
So
Need a quick
when
answer.
we go commercial, we talk office, okay?
Yes.
There's a lot more to commercial than office,
I'm
but
glad you made
office
that
is that. And if you look at it, New York is having this massive renaissance. People are back in the office. You walk around here, there's a lot of activity. Clearly, there are concerns about the mayoral race and who the next mayor of New York is going to be. But I just had the privilege of touring the new J.P. Morgan headquarters last night, and it is a stunning building, and it is emblematic of people back in the office and making this city what it is.
But it's pre-Mamdani. Would you build something like that now?
I don't have the need to make that decision, Sarah, but I would say that people are looking at that with some skepticism right now, and we'll see how that plays out. But the only other thing I'd say on that is, as most people know, the mayor has a certain amount of authority, but not tons to be able to change the market that quickly. But New York is on a roll, and the one other thing I'd say to you really quickly is that so is San Francisco. There are a lot of people who've been sitting around saying, when's the moment to move into San Francisco? I continue to hear people saying there's an opportunity to step into San Francisco right now, which is very unique.
Wow.